All right, well, why don't we go ahead and get started? I want to thank everyone who has joined us today for our quarterly market investment update, and a special guest will be joining me for a financial planning check-in. My name is Greg Estes. I'm a co-director and CIO at MBI, the wealth management subsidiary of the accounting firm CBM. We're thrilled you've chosen to spend the next hour with us. Obviously, there's been a lot of volatility and a lot of things going on in the market. Um, so we just want to be able to kind of break that down for you. I will be joined by Stephanie Anderson, who is a manager of financial planning and wealth management services along with me at MBI. And together we have decades of experience, and Stephanie's going to be covering a financial planning check-in. There's no time like the present to get up to speed with what you should be doing in your financial plan. Um, so let's just break down what we're going to be looking at. But before we dive in, just a couple of quick housekeeping items. Video and audio are turned off for all attendees, but we do encourage you to ask questions throughout the presentation. You can simply type them into the Q&A tab in your control panel at the top. We'll be monitoring and answer as many questions as possible during the Q&A session at the end. And if we run out of time and don't get to your question, don't worry. We will follow up with you after the webinar. Okay, so the topics today, no big surprise, we'll be talking about the economy, and then we'll be shifting into market fundamentals, what's going on in markets, specifically on corporate earnings, and then a word on international investing. Then we will go into our mid-year check-in. So this will be primarily about your financial plan, especially in light of all of the uncertainty that we have in the current environment. Sorry about that. Okay, so at the risk of dating myself, I remember a time when I used to watch television, broadcast television, and they had these things called commercials. And sometimes there'd be a commercial for a movie, these things that we saw in movie theaters. And in the advertisement for this upcoming movie, they'd usually have a quote from some movie critic like Gene Shalit or someone like that. And I remember one of the lines would have been, I laughed, I cried, or gripping, compelling. I just thought of that because I kind of feel like the environment we're in today is a bit of I laughed, I cried. There has been a lot of noise coming out, primarily out of the administration, and most of it has been around trade policy. So, you know, before being elected, Donald Trump talked about the fact that he liked tariffs, and then once he was elected, referring to himself as a tariff man. So we had this kind of conversation going in the early part of the year, but then come April, we had what was reported to be Liberation Day, where a lot of reciprocal tariffs were announced. The chart is showing you kind of an effective tariff rate starting at the beginning of the year. And a couple of things should jump out to you about this chart. One, this effective tariff rate has moved around quite a bit. And two, despite the fact that it's moved up and down, it's generally speaking been trending up. So when we started the year, US trade policy had an effective tariff rate of less than 5%. We're kind of leveling out right now to 15%. Some key points that I tried to summarize to the right. One, we had the April announcement with these large reciprocal tariffs, and then immediately after, within a couple of days, a delay in the implementation of those tariffs into July. That was pushed back to August 1st. We've reached a couple of deals with some countries, the UK, 10% broad tariff with the UK, Japan, that deal was just reached, 15% broad tariff and auto tariffs reduced down to 15%. China negotiations are still going on, and there's a lot of kind of smoke coming out of the White House that the base tariff rate for a lot of these countries, where the reciprocal tariff was significantly higher, would be more in that 15 to 20% range at this point. Who knows? The US and the EU have not come to a deal yet. Again, the EU is a third largest trading partner. So all of these tariff changes and announcements and noise coming out of the White House has led to a great deal of policy uncertainty. So when we talk about policy uncertainty, there are actual indexes that try to distill what that means. So looking at this chart is showing you economic policy uncertainty in blue, trade policy uncertainty in red. What are these things? So it's a measure looking at major newspapers and the amount of instances in storylines that mention uncertainty with respect to either economic policy, which is broader than trade policy, including taxes and other regulations, or specifically with trade policy. So it covers kind of mentions in newspaper. It also covers dispersion among economists and their forecasts for what these policies will look like. So it's trying to distill this into a number. And you can see trade policy had not been very volatile or uncertain for a long period of time, and it spiked obviously in early April with the announcements. Economic policy kind of following in that same direction. Fortunately, both have started to come down, and this is going to be a narrative that we see this year as markets recover, which is things aren't as bad as we feared back in April. So just keep that in mind, because that is kind of a recurring theme throughout this presentation, is things aren't as bad as we thought they might be in April. So looking at current economic conditions, the chart on the left is showing you economic growth on a quarterly basis going back to 2021. And so these purple bars represent numbers that have actually been reported on a percentage basis. So if you look at this, the most recent quarter reported was Q1, which was released back in late April, early May, showing that the first quarter actually declined by 0.3%. Why is that? Well, one thing to consider when we talk about economic growth, we're typically referring to something they call GDP, gross domestic product. So all goods and services produced in the US. So companies, knowing that there would be some sort of tariff announcement, tried to get ahead of it in the first quarter by importing as much as they could. So, stuffing their inventory, just buying as much raw materials as they could. So net imports is actually kind of counts against you when you're looking at your gross domestic product. So that explains that decline in the economic growth for the first quarter. Now, that's not likely to continue, because now we have these tariffs in place. The buying patterns would kind of go back to a more normal level, which means that a lot of these high imports that we saw in the first quarter will reverse themselves. So economists expect growth over the next several quarters. Those are the gray bars, more moderated than before, but nonetheless positive. The chart on the right, this is an estimate for the second quarter. Now, the second quarter has ended, but it hasn't been reported yet. The Atlanta Federal Reserve Bank estimates the GDP release with a GDP now, and that's this green bar. And the blue kind of shading is estimates among economic forecasts. So you can see that's positive, it's trending up. The green estimate is a little bit higher than that. It will remain to be seen what that result is. But I think the key takeaway here is that the expectations are for positive growth in the second quarter. Okay, rather than go into a lot more detail in other releases like, how many jobs are created in the US or unemployment rate, et cetera, we can distill this into kind of an amalgamated index, the economic surprise index. And the way to read this is it shifts below zero, above zero. So for every economic data point that's released, there are estimates for what that number is going to be before it's released. So expectations. So this is kind of looking at the actual results versus expected results. And when the actual result is better than expected, that's a positive surprise. When it's worse, it's a negative surprise. So, these lines tend to move above and below zero depending on kind of what the actual results are versus expectations. And what you can see if you look very closely is the most recent readings, these numbers have actually started to post above zero. In other words, positive surprises. This again goes back to the narrative that things aren't as bad as we feared they would be in April. So that's generally a positive for markets, knowing that the worst result isn't actually coming to fruition, at least for the foreseeable future. I do want to mention inflation on its own. We've talked quite a bit about inflation, and I know I've shown this chart before. The way to read this is showing you two different inflation numbers. The yellow is Consumer Price Index. The Department of Labor kind of manages the CPI number. The PCE is the personal consumption expenditures. In red, that's the Department of Commerce's baby. And it just kind of, you can see back in 2022 how high inflation was. And the Federal Reserve's response to that high inflation was a little bit late. Nonetheless, they raised the Fed funds rate. The Fed funds rate is that overnight rate, interest rate that banks can charge one another. And that went from near zero to 5.5% in a very short period of time. And the idea there from the Federal Reserve is, hey, if we can raise these really short-term rates, that slows the economy down, that kind of slows that inflationary cycle. And it does work. So you can see that inflation did start to come back down slowly, but surely. Both measures kind of now below 3%. But what's important to note here is that these results have remained stubborn. They have not continued to really trend down. The Federal Reserve last year went ahead and decided to cut interest rates 3 times, totaling a full 1%. So the Fed funds rate right now is at 4.5%. But expectations going into the end of last year were that maybe we could get some more rate cuts. At this point, the Federal Reserve has held pat on not cutting rates, partially because they're concerned that these inflation numbers are not, they don't think, or they're concerned that they're not going to trend down or continue to trend down, especially in light of the fact that we have these new tariffs in place. And there's concern, well, I should say it this way. If the economic numbers look pretty good, there's not really a pressure to cut rates because the economy is slowing down. So that's sort of the narrative coming out of the Federal Reserve. I guess the counterpoint there would be, even if inflation doesn't continue to trend down towards 2% and the economy stays strong and we don't see tariffs, impacting inflation much, then we go back to that soft landing narrative, which is that, hey, the economy isn't really slowing down, but inflation is good enough that we can cut rates. So the market doesn't feel that the Fed is there yet as far as cutting rates, but they're getting closer to that notion of cutting rates. And that does have implications for stocks. Stocks generally behave well when interest rates are cut. So that remains to be seen what happens there. Okay, so just looking really quickly at what's happened in the stock market this year. So this chart shows you kind of year-to-date performance for 4 indexes, 4 stocks. So we've got different categories here. The blue line, the Russell 1000, those are large cap stocks. The red line is the Russell Mid Cap Index. The green line, Russell 2000 Small Cap Index. These 3 indexes are domestic. They're US based. And then the All Country World Index ex-US is the MSCI index, and that is covering every stock outside the US. So you can see kind of, we started out the year with results going into the positive, but mid-February, the domestic indexes started to sell off on concern that there would be tariff announcements, and then you can clearly see where the tariff announcements in April were, and that led to a pretty significant two-day sell-off, ranks in the top 10 among sell-offs since the 50s in stocks. So, at that point, the market's very, very concerned about implementing these huge tariffs. It didn't take long before the administration backtracked and put a moratorium on the implementation of these reciprocal tariffs. And you can see that kind of jump up in around, April 8th. And then from there, the markets have slowly begun to recover as this narrative sort of took shape that things weren't going to be as bad as we feared, and that these reciprocal tariff rates, which were very high in some cases, don't appear to be what will actually be enacted. I do also want to mention at this point that there's even litigation going on that I believe it's the IEEMA, which is an emergency economic, basically powers that the executive branch has used to implement these tariffs, which is really supposed to be used in the event of some sort of crisis affecting the U.S. economy. Courts have ruled that the president can't use these tariffs or this act, the IEEMA, for implementation of tariffs. That ruling has been stayed. We won't even hear arguments on that until late September. So we're kind of left with the notion that, we move forward with what we know, which is that tariffs are likely to be implemented, but at lower levels than we feared back in early April. So we'll keep an eye on what the courts rule, but at this point, we're dealing with what we know. So markets have recovered for the most part, and what has recovered the quickest has been tech. So this is a different index. This is the Morningstar US Large Mid Index, and it's showing you quarterly returns, total returns, going back to the third quarter of 2022. And what's interesting about this is the blue shading is the technology sector within that US Large Mid Index and what its sort of share of the total contribution to return has been. So if you look at the first quarter of 2025, it was negative, and tech was the leader, the most impactful to that negative return. But the flip side of that is that tech has been leading the charge in the second quarter with the recovery in markets. And this kind of indicates to us that, with tech being kind of in the lead, that growth is kind of taking the lead right now over value. So what I want to show you in this chart is sort of how expensive growth is versus value. Growth is typically more expensive than value because people place a premium on earnings growth in businesses. But just looking at forward PE, what the way to distill what forward PE means, it's how many dollars are you willing to pay for a dollar of future earnings? So over the next year, a dollar of earnings, how expensive is that? So what you can see is the red line is value, the blue line is growth. These are different categories of stocks. And what has reflated very quickly has been how expensive growth stocks are. They've kind of really rebounded very quickly. So there's a lot of momentum right now in growth stocks. I do want to also point out, though, when there was a lot of fear in markets, when there was a lot of volatility in markets earlier in the year, they were the thing that deflated the quickest. So at these higher levels, to me, it implies that there's potential for more volatility down the road, particularly with respect to growth stocks. They are definitely a leader right now. There's more risk-on behavior in markets. Just something to bear in mind when you're looking at your portfolio. If you're heavily exposed to tech and to growth, just be aware of how that might impact your portfolio if volatility does indeed pick up. All right, so I do want to spend some time on corporate earnings, and I will kind of break down this chart. It's actually going to be over the next few charts that I talk about earnings. And what we're looking at in this chart are earnings per share for the S&P 500. So as a whole, earnings for the S&P 500, and it's broken out by each quarter of this year. So the first quarter of this year, which is already over and done with, that occurred January through March. Second quarter, third quarter, fourth quarter. So if we look at these, this chart starts back in the second quarter of 2024. Well, results don't get reported until 2025. So what you're looking at for a lot of the timeline in this chart are expectations for earnings in the first quarter in blue, and in the second quarter in red. So as we move forward, these expectations start to get cut. So if you see this trend down, this is, analysts, Wall Street analysts are the ones that are primarily building their earnings models and building their expectations for what companies are going to report. And then that's combined into this total earnings for the S&P 500. You can see as we kind of went from the fourth quarter of 2024 into the first quarter of this year, a lot of these expectations for all of these quarters were getting cut. And a lot of that was due to concerns about tariffs. How much would that cost companies? Really unknown. So analysts are doing, trying to come up with the best estimates that they can. But when things are highly uncertain, you can understand that would cut earnings expectations. So focusing on this blue line, so Q1, it comes and goes. Results for the first quarter don't get reported until we get well into April and into May. And you can see where I've circled for Q1, the actual results exceeded expectations, which is why you see this slope down and then this jog back up. Those actual results their actual results now for the first quarter exceeded expectations. And I've got question marks for a Q2. You can see how analysts have really cut those expectations for what Q2 results are going to be. Q2 ended June 30th, but those results are now getting reported. Last week, we started off with a lot of the big banks like JP Morgan and Citigroup, and those results were better than expected. So if that trend continues, and we've seen that with NVIDIA and with a couple of the Magnificent Seven coming out, not Tesla, which is reporting disappointing results, but by and large, for a lot of these companies, if they do report results which are better than expected, then that red line is going to do the same thing as that blue line. So that means positive surprises for these companies, which is generally good. We like to be positively surprised, not so much negatively surprised. I do present this in a different way, looking at corporate earnings for full years. So each of these blue lines represents a full calendar year. Just to, a couple of key takeaways on this. One, if you look at each of these lines going back from 2023, 24, 25, and 26, they're each successively higher than the other, meaning there is earnings growth on the full year basis every year. And you can see that 2025 and 2026 did dip down. And a lot of that is due to analysts cutting those expectations given what we know or don't know about tariff implementation. So that pulled back earnings expectations for those years. But you can also see that those cuts stopped, and now those expectations for 2025 and 2026 have kind of moved sideways. So again, the idea being that we can, a lot of the bad news from these tariffs has been kind of fully baked into expectations going forward. And backed by popular demand, I wanted to show you the asset class returns quilt. So the way to read this graphic is to look by column, and each column represents a year. And each color represents a different asset class or category of assets that we can invest in. And it's ranked. So the highest performing asset category for a year should be at the top. And the rightmost column represents 2025 year to date. This is going through June 30th. And you can see what's at the top are international stocks. International developed at the lead at 20.4% total return in 6 months. International emerging following not too far off that. A key consideration here, one point I do want to make, because I try to make this every time I talk about this, we call it a quilt because there is no pattern here. The colors are in different orders from year to year. This is kind of an empirical evidence that one shouldn't put all one's eggs in one basket. You should have different asset classes in your portfolio and maintain exposure in different asset classes. Going back to international investment, that had been, over the last several years, kind of a lagging category versus US stocks. And that's been quickly reversed this year. So we've gotten asked in the past, hey, why do I own international stocks? They've been underperforming. Well, you own it for situations like this where markets change and things change, and you want to have exposure to other areas of the market. I do want to point out something though. It isn't just the tariff itself that's caused international stocks to outperform. That was kind of the catalyst for international stocks to perform better than US stocks. But a big driver here is currency. How has the currency impacted foreign stocks? So if you're a US investor and you have some of your portfolio in international stocks, what you're owning are stocks that are based in other countries that are denominated in other currencies. So if the dollar weakens, which it has this year, as you can see in this chart, the DXY is kind of the dollar versus a basket of other currencies has declined by more than 9% year to date, which is a pretty big move in currencies, whereas other currencies like the euro and other European countries, Mexico, Brazil, basically everything else, has appreciated. So if you own stocks that are denominated in foreign currencies, when it's translated back into US dollars, even if the stock didn't move in terms of foreign currency, you have more dollars than you had before. So that definitely has impacted the total return on international investing. It's not the only reason, but it is a big driver. And I say that because I get asked by some people why I shouldn't buy more international. And if you've got an allocation to international stocks, simply buying something because it's gone up may not be the best rationale to do that. And understanding that currencies do fluctuate. They're very hard to predict, the currency movements. They don't just continue to move in one direction. So the dollar typically is traded in a range. It's getting near the bottom of that range. Could it go lower? Sure. But I would not make a judgment to add to international if it's not really appropriate for you, simply because you've seen good results in the last 6 months. Particularly if we see the dollar start to strengthen a bit, that could have an impact on your international allocation. So with that, I'm going to stop, and I'm going to hand the ball over to Stephanie, who's going to conduct our mid-year financial planning check-in.
Great. Thanks, Greg. Good morning to everyone. It's great for you to take time out of your busy schedules for this market overview and also for this mid-year check-in. With that, let's just take a look at the first slide, which is a selection of headlines. Can we get to the next slide? Great, thank you. This is just a collection of headlines that we've seen in major papers over the last several weeks. And it's really intended to highlight that when you watch the news or read the newspaper or, however you digest your news, it's a barrage of information coming at all of us. It can be quite overwhelming and exhausting just to simply watch the news or to read the paper, whether it's war, whether it's natural disaster, whether it's ICE raids, it's some sort of political scandal, or as Greg was touching on, economic and market related matters. It's just a bit of sensory overload. So these sorts of things can cause people to become afraid, nervous. Sometimes, we want to make decisions in a knee-jerk fashion simply to feel a little bit more calm. This sort of check-in is important to make sure that we're making decisions ultimately with our end goals in mind, and we're keeping our wits about us and not making rash decisions that may be detrimental to our long-term financial future. I found this graphic on the next slide, which is looking at boats and planes. And I thought it was a really helpful visual for thinking about this kind of mid-year check-in. Whether you're thinking about a boat or a plane, the same concepts apply. If I were crossing a body of water, a very still, placid body of water, and I wanted to go from point A directly across the body of water to point B on the other side, if there were no current, I should have no difficulty getting to my destination with ease. The moment you introduce a current to that flowing body of water, I'm going to have to make some course corrections, or I'm going to drift downstream and therefore be away from my targeted destination. Same thing with planes, right? If the minute you introduce wind or turbulence or any of these other sorts of factors, you are drifting off course. You may think about it in a way of looking at a map. Where are you right now? Where are you trying to go? And drawing a straight line. In both of these cases, whether it's wind or current, once those are introduced, you're going to be shifting away from that line that you've just drawn, and some sort of course correction is necessary so that you wind up actually at your destination. Taking a look at the next slide, this schematic is just sort of the 4-part review that we do with clients when we meet with them periodically to go over their portfolios and assess goals and update plans. All of this conversation starts with, what are your goals? We want to revisit those, or if you haven't set them, to establish long-term goals and to make sure that those are really clear and locked in, because of course that's the destination that we are targeting. The second step in this process is to just assess where you are right now. Has anything changed with your current situation, whether it's employment or family situation, a marriage, a divorce, a death in the family? Are you contemplating a move to a different state? Are you thinking about actually retiring? Where are you right now? Then the third area is to identify any items that need immediate attention. Or attention in general, right? Immediate attention areas might be, you have young children and you have no will or trust or estate plan of any sort, and you haven't designated a guardian for those minor children. That would warrant immediate attention. You might also say, if you have no life insurance, right, and you have small children and a mortgage and a spouse, that would be something that would be immediate attention. Another area that's important as well is healthcare and financial powers of attorney. Really important, particularly in this era of all these natural disasters that we've been hearing about in the news over the last year or so. And then the final point in this mid-year review is to update your route if necessary, right, to course correct so that you can get back on track to reach your ultimate destination. It's a really simple 4-part process that we do at the beginning of the year, and then again in June, July, as we arrive at the midpoint of the year. Looking at the next slide, a couple of the areas that we're focusing on, these are what I would call your load-bearing pillars of your financial plan. Those who've attended these webinars in the past are likely familiar with this. It's a really straightforward 5-part structure that allows you to keep just a handful of things top of mind. The first is cash flow. right? This is important for anyone, whether you're just starting out, whether you're mid-career, whether you're on the runway to retirement, or you're actually in retirement. What's coming in? What's going out? What's your net worth? And do you have a handle on things? And is the situation there such that you are going to achieve your goals with ease? Or are there areas that need some attention? In that case, we'd want to focus on those. So cash flow is the first point for the discussion. Next, unfortunately, we can't escape taxes, so we have to factor that into the mix. Here we're focusing on what is your marginal tax bracket, what's the average amount of taxes that you have paid, what is your income forecast for this year, and is some bracket management necessary and appropriate so that you're not inadvertently bumping yourself up into the next higher tax bracket. You also want to think about ways that you can optimize taxes. Is that through the creation of a Roth or doing some Roth conversions? Is it through increasing your pre-tax contributions to retirement plans? In terms of deductions, with the new higher standard deductions, you may want to evaluate, does it make sense to claim the standard deduction, or should you be itemizing? Or maybe you're changing that from year to year. This is a dynamic area. It's unfortunately not a set it and forget it. But the focus here is, do you have a plan for income taxes and for bracket management? Third area of focus is on investments. Here we are really making sure that the investments, which is really your funding source for your retirement, is in line with those long-term goals. You should have a written investment policy. You should really have a keen understanding of what your ability is to stomach risk, right? Of course, everyone likes risk when markets are appreciating and things are going great guns, but those things that go up very frequently come back down, and sometimes with a plunk. And so we want to make sure that you're not taking on more risk than you really could stomach. And this written investment policy is intended to capture that and to be your sort of true north in terms of how we manage the investment portfolio. For those folks who are in retirement, it's really important to have some kind of a drawdown strategy. How are you going to draw down your assets over time? Which buckets are you drawing from? How are you going to be rebalancing over time to make sure that you are funding your lifestyle over the long term, and of course meeting any legacy goals that you might have. The focus here is not only on asset allocation and diversification of your assets, but also on location of assets. You ideally should have a good mix of taxable assets, tax-deferred assets, and then, of course, tax-free Roth. As well, you should have some cash in there for emergencies and just kind of to tide you over so that you're not withdrawing from the portfolio in the event of a market downturn of some sustained nature. The fourth area here is estate planning. Here, we're just making sure that you have your basic documents in place, whether it's a will, a trust, guardianship documents for minor children, the healthcare power of attorney. So if God forbid you're unable to make decisions for yourself, someone else could make those decisions for you, that your beneficiary designations are up to date, and that you have a plan for any charitable giving, if that's a priority for you, and ultimately for legacy planning. So here we're just doing an assessment. We have a roster of estate planning attorneys that we can refer clients to if your documents need to be created or updated. In the planning process, we're really just looking to make sure everything is in good order and that there are no gaps that could later come back to bite you or your family. And then the last area is insurance or risk management. This is really, again, just to do an assessment. We can refer you to insurance brokers or specialists in this area for follow-up, but we want to make sure that you have a keen understanding of what kinds of risks could derail your plan, whether that's a premature death, a disability, some kind of a long-term care expense or illness, etc. These are kinds of things that kind of come out of the blue, but they could totally derail your plan. They're unexpected, and they're usually very large kind of ticket items. So we want to identify those and then do some financial modeling and planning so that you can ideally minimize or even neutralize the downside occurrence from those types of events. Here, this is typically insurable types of risk. The key question here is, do you want to offload the risk to an insurance company, or do you want to self-fund? So this is the framework. These are the 5 areas that we're always keeping in mind from a planning perspective. Taking a look at the next slide, we on July 4th, the One Big Beautiful Bill was signed into law. Regardless of what your thoughts are on this bill, it's now the law of the land. And so we need to get our arms around it. There was so much uncertainty as we were approaching the end of 2025. Everyone was just wondering what's going to happen. Are the provisions of the 2017 Tax Cut and Job Act going to be extended or not? We have an answer to that. So that's one area of uncertainty that has been cleared up in some measure. I won't go through this whole slide in detail. Of course, we could spend 2 or 3 hours or more talking through the tax bill. I'll just highlight a couple of things in no particular order. There are some provisions of the Tax Cut and Job Act that were made permanent. For example, the bracket structure that we've all been operating under has been made permanent. The larger standard deductions have been made permanent. This is why I was mentioning it's an area that continues to be, for those who are considering itemizing versus standard, this is an area that you likely will want to revisit on an annual basis and come up with a strategy there. The $750,000 limit on mortgage debt that qualifies for the purpose of mortgage interest deductions has been kept at $750,000. This may be an issue, particularly in higher housing cost areas where people may have more mortgage interest that is not deductible. Another thing I'll highlight is that there is an itemized deduction limit for those in the highest tax bracket. This is something to keep in mind, right? When you are itemizing those deductions, that you just want to be mindful of that. On that same vein, for those who are charitably inclined, there is also now a floor, a 0.5% floor, 0.5% of AGI floor for charitable deductions. So your deductions need to be over that amount in order for them to be deductible. So something you want to keep in mind. There's now a floor for those deductions, and then for those in the highest tax bracket, there's a limit on the amount of deductions that you can itemize. Skipping over to the middle column, I'll highlight just the quadrupling of the state and local tax deduction. This has been an issue that we've seen discussed and debated significantly in the news. This has been put in place. It was $10,000. It's now been increased to $40,000 for tax years 2025 through 2029, and then it drops down back to $10,000. After that, there is a limit in terms of phase outs for income. So you just want to be aware of that if you're falling in those higher income brackets. Another thing I'll highlight is the expansion of qualified expenses for 529 plans, something to be aware of for those with children, whether they're in grade school or in college. And another closely related area, one of the new provisions is 529s can now be used for expenses to attain or maintain an eligible post-secondary credential, such as the CFP or the CFA, CPA. I would imagine CFA probably falls under that category as well. But the point here is if you are maintaining these credentials or trying to earn the credential, it's something you might want to keep in mind in terms of the creation of a 529 plan. What else is worthy of note here? There is a new additional deduction for seniors, those over the age of 65. This is an addition to the deduction for people in that age category. Just something to keep in mind. Some clients may not qualify. There are income limits here, so just be mindful of this. You may want to talk with your advisor or one of the members of the tax team to get some additional clarification here. So again, we could talk about this for 2 hours or 3 or more, but just a couple of things that are likely to come up in your planning conversations. Taking a look then at the next slide, this might be something that you print off once you get this deck and post on your refrigerator or your bulletin board, wherever you put important things, just to keep these sorts of concepts front and center as you're doing your own mid-year check-in after this webinar, and as you just plan and map out how you want your finances to flow for the balance of this year. Again, you see the familiar categories that we discussed before. I'll just highlight here a couple of things. The key questions we covered a couple slides back. The action steps highlighted here are intended to be things that you could do today. You could start them, and maybe in some cases you could finish them today. Immediate action steps. And then the planning opportunities are things that you will want to chat with your advisor or potentially a member of the tax team about to run some scenarios, maybe to run some cash flow or retirement projections, some tax projections, to come up with a couple of options so that you then can evaluate those options and then, of course, determine what the best course of action is for you and your family based on your overall goals and objectives. I'll highlight a couple of things here. I think it's fairly self-explanatory, so if we don't get to a particular topic, you can, of course, shoot us a question and we'll be happy to address. But I'll just hopscotch through here. So for cash flow, what are some things that you could do this afternoon? If you aren't already tracking income sources and the timing of those income sources, that would be a really fruitful activity as one of these action steps. Analyzing expenses and the timing of those expenses. Do you have a big tuition bill coming up? Is there a big trip you're planning for? Whatever it happens to be. Are you planning to buy a house? What does that look like? Or do a reno on an existing house? What I'll highlight here is the importance of having a contingency plan. We've all seen, articles about DOGE and federal employees, being summarily escorted out of the building where they were working. This is sort of top of mind at the moment, but these kinds of unexpected events, job loss, health issue, divorce, some kind of large expense that comes out of the blue are things that we all should have a contingency plan for. How would you fund them? Is that money in a safe, relatively risk-free location? Some longer-term planning opportunities pertaining to cash flow would be, again, timing of income recognition. Is it appropriate to do a Roth conversion? When might you take your first RMD? Would you take it when you're first eligible to, or would you defer it so that you're taking 2 RMDs in that next year after you've turned 73? So this is something to keep in mind, again, relative to what your marginal tax brackets are. In the tax column, what are some things that you could do, again, this afternoon? You could evaluate what your withholdings are thus far this year. You could chat with, one of your tax experts to determine what your projected tax liability is going to be for the balance of this year, for 2025. Are some, course correction actions necessary in that regard? So these are things that could be done fairly quickly. Something that would require maybe a little bit more analysis would be, does it make sense for you to claim the standard deduction at its higher level, or should you be itemizing? Here, the question is likely to center around bunching strategies, right? You may decide to take the standard deduction this year, but next year you may decide to bunch your charitable deductions, several years worth of charitable deductions into one, or you could do, other deductible strategies. You may bunch them. The point here is that you may be claiming the standard deduction in one year, itemizing in the following year, and then going back to the standard deduction in a subsequent year. But this is going to require some analysis and projections to determine the most appropriate course of action. In terms of investments, as we touched on, you always want to make sure that you have appropriate diversification across the asset classes, as well as by account type and by asset location, right? You probably don't want to have a lot of investments that are throwing off income in your taxable account. Unless it's perhaps municipals, but you likely would want to have some fixed income or maybe a significant portion of your fixed income in a retirement account. Again, these are sort of general rules of thumb, but you'd want to do some specific analysis for your individual situation. Let's see. Thinking about the realization of capital gains, when that should occur, and trying to minimize the capital gains tax impact there is always important. And another thing I'll mention here is 529 plans. We've all heard of these Trump accounts that have been introduced where for babies born between 25 and 28 who have Social Security numbers, $1,000 is going to be just contributed to those accounts. So this is something to consider just in the overall context of 529 plans and longer term funding of education expenses. On the estate planning front, what are some things that you could do this afternoon? Well, you could take a look at how old your estate planning documents are. When were they last updated? Do you have an electronic backup copy of those documents? In the event that your house was washed away or you no longer could go back to that place, do you have access to these? And again, making sure that anyone who is designated to follow up or to act on your behalf in those documents knows about the existence of those documents and can find them in the event needed. And last thing I'll highlight it, this always comes up for those families with college-age children to make sure that you have, at a minimum, healthcare POA docs in place for college-age children. We always hear sad stories about people whose children have gone away to college. They had some sort of an injury, but they're technically adults, and the parents don't have access to the medical records or the ability to make medical decisions on that behalf. Estate planning is not just for older people, it's for college-age folks as well. And then in terms of longer term planning activities under the estate planning column, really important to evaluate for those who are engaged in gifting strategies. Do I want to do a donor advised fund? Do I want to incorporate qualified charitable distributions as part of my strategy? Am I doing a combination of these things, or what's the mix? What is the most effective strategy for my particular situation? Again, here bunching may apply for those charitable distributions. It may also apply if you're doing some annual gifting as well. Also important, the higher federal estate tax exemptions have been made permanent, but let's not forget about state estate tax levels as well. So important to keep that in the mix. And then lastly, on the risk management front, what are some things that you could do this afternoon? Do you have an electronic backup copy of all of your policies? Have you done a video inventory of your house in the event that your house disappeared and you needed to make a claim? And do you have, I guess, the equivalent of a financial to-go bag in the event that you had to leave your house? I think this is something that increasingly is top of mind with all of the natural disasters, floods, fires, earthquakes, etc., that keep popping up in the news. Longer term planning opportunities here would be to evaluate to make sure that you have the appropriate coverage levels in place. And then lastly is to do some sort of evaluation of the potential cost for long-term care and then to develop a plan for covering those expenses. Greg and I are not licensed to sell insurance, so we don't have a dog in this fight. But this is an important area. If you're thinking about things that could derail your plan, this is one of those areas. There's no right answer, right? You could decide to offload to an insurance company. You could decide to self-fund. You could decide to do some combination of the above. But the important point here is to have a plan. So those are the high-level areas to delve into when you're doing your mid-year check-in. Some things you can do on your own. Some things it would be recommended to chat with your financial advisor or with your tax professional as well for more detailed analysis, projections to help you determine the best course of action and any course correction activities that are necessary so that you can stay on track to achieve your ultimate goals. And with that, we'll take a few questions.
All right. Yes, feel free to submit any questions you have in the Q&A box. I would like to get the questions started. We did have some registrants submit questions in advance. And Stephanie, this one is about quarterly estimated federal tax payments. This individual read that the federal government would no longer accept mailed-in payments. Is that true?
Yes, curiously, it is. The president signed an executive order earlier in the year to sort of upgrade the payment and disbursement system. So it's slated to be effective September 30 of this year. That tax payments to the extent possible should be made electronically. You can go to the IRS website for further detail about setting up accounts for direct payment or ACH or other electronic methods. It will be interesting to see how this unfolds because the IRS, of course, is busy with a lot of different things, right? They have a new tax law that's in place. There are a lot of they have a reduction in headcount. We were told in the executive order announcing this change that there would be a robust public service announcement and campaign. I have not seen anything on the TV or in print on this, so we stay tuned as to whether this actually goes into effect on September 30 or whether there is some pushback. But we should begin to investigate those electronic options for making estimated payments and, of course, your annual payment for taxes in the event that the deadline is adhered to.
Good advice. Also, just consider that, mailing in a check does rely on the post office to make sure that that gets to where it's supposed to go in a timely
Exactly.
fashion. So
Exactly. That can be dicey. On any given week, I get at least 3 or 5 pieces of mail that belong to my neighbors. So then I have to go walk around and distribute. So this is unfortunately the current state of our mail system.
We did get a question. It was kind of multi-part. There was an opinion on investing in gold and about interest rates and housing market. Just really quickly on gold. So gold right now is at about $3,400 an ounce. It's near an all-time high. So it's obviously drawing a lot of attention. It's had a fantastic return if you look back over the last year, over the last couple of years, even going back to 2023. Something to keep in mind with gold. So one, if you buy physical gold, it doesn't grow itself on inflation. Inflation has no impact on it. You're strictly owning something, a commodity that you think will become more valuable in the future. And that the underlying economics of it are when there's a lot of uncertainty, gold prices go up. So when there's a lot of instability, gold prices go up. And if I look back, going all the way back to the 80s, there are periods of time when gold peaks and then craters. So, in 2010, gold was at a peak. In 1980, gold was at a peak. It's at a peak right now. So the returns look really good depending on your time frame. If I go back to the 80s, my annual return on gold right now is under 4.5%. So, buyer beware. If you're looking at buying gold right now, you might be buying it at a peak. Could it go higher? Sure. There's plenty of instability if one were to look around. But if you have gold in your portfolio, you should be very pleased. But maybe you don't want to be adding to it when it's at an all-time high. As far as interest rates and housing market, interest rates or mortgage rates tend to be really connected to the 10-year Treasury, which is a longer-term rate. The Federal Reserve is controlling very short-term rates. If they cut the Fed funds rate, it doesn't necessarily mean that the 10-year Treasury goes down. It may a little bit, but what we could see is a yield curve steepening. Sorry, I'm getting a little technical here, but the point is, even if the Federal Reserve does cut interest rates, it does not necessarily mean that mortgage rates come down. Um, can we get back down to the mortgage rates we had back in, a few years ago? Might take some time for that to even be on the radar screen, because back then we had interest rate policy near zero. So we might get some relief with a Fed funds rate cut, but again, it's tied to a longer term treasury rate, which impacts mortgage rates. So stay tuned and stand by when it comes to mortgage rates. With that, we are about out of time, so I want to thank everyone for joining us. As I said, this webcast will be recorded and rebroadcast for those that wish to listen again, and we can make available the slides for this presentation. So again, thank you so much for joining us.